Let's talk about how you can trade the 112 on crude oil futures specifically with about a 96% win rate, and exactly when to do it and what to do if things go against you. I think it's really important. The 112 is a really good strategy, but you have to understand how to work it on every single product differently, because it doesn't just work on everything all the time the exact same way. So the short put should be a delta 5 to 15. And to decide which one we actually should choose, we will have to analyze the graph, and I will go over a live example right away as we get on with the slide. The long put spread should be a delta 25 to 45. The higher the better. Obviously, you get more protection this way. But again, we will have to analyze based on what we got. And I'll show you an example. You'll see it's way easier than you think. And the DT should be around 45 days because you have a lot of theta at 45 days. So you can be in and out of the position within 10 to 15 days at most. Really, even probably even less for the most part. The take profit is always going to be 50% of credit. This is because we want to maximize our profits and efficiency and be out of the market as quickly as possible. There's no reason to try and wait to collect all the credit, because out of the 45 days, you can get the to the 50% within 6-7 days sometimes, right? Let's say 10 days. So there's no point waiting another 35 days for another 50%. We can just reposition if we need to and open another position and profit more this way. For the risk management, really important, you can sell the futures contract if the price reaches the short put strike, which is extremely unlikely, or you can have a stop loss at 200%. Or, which I think is probably the best kind of course of action, to roll the short puts when they're down about 100% of credit, and to roll them into the next expiration, and obviously try to collect the same amount of credit that the puts are worth. And I have a video about rolling puts. I'll link it below. It's really important to understand exactly how to do it, what are the mechanics. And this way you can roll the put. Let's say the put is at level 100 and the price moves down, so we can roll it, collect all the credit we need, and roll the put to level 95 or strike 95, for example. And this way you create more range for yourself, and you collect more credit, obviously, to offset the loss, and you have more time to be right. This is probably the most efficient way to deal with the 112, assuming that you entered at a good time and fundamentals hasn't changed. For the position size, it should be, well, you should collect up to 2% of the account in credit, because risk has to be low on those directional trades. Anything can happen, obviously, at the end of the day. This is my personal preference. I'm pretty, I don't take much risk. So keeping positions small will just make it easier to manage them. So when would you enter a 112 on crude oil? This is the biggest thing, right? Because this is all good and nice, but if you don't know exactly when to enter, it can be a complete disaster. So the price must be in a clear side trend or an uptrend. That's pretty easy. And it works best with geopolitical tensions. So if there are geopolitical tensions, for example, conflicts, Middle East conflicts, Russia, Ukraine, for example, what else do we have? Tariffs, stuff like that. There's usually a really good chance the price of crude oil will either stay the same or shoot up, because crude oil kind of acts somewhat like gold, not exactly. When there's tensions, it can go up, and therefore it will be good for us because we are selling the 112. So let's analyze the current graph of crude oil and see what kind of strike we should choose for our short put. So as you can see, this is the current price. So clearly it's somewhat in a side trend. Lately it's been just going sideways over here. So I would call it definitely a side trend. And currently in this market conditions, we have a lot of tensions in the Middle East, Russia, Ukraine, so on and so forth. So you don't expect crude oil price to come crashing down completely. Obviously anything can happen. This is why we keep the position size small and we can roll it. But generally speaking, I would say probably based on a graph, we can probably go to strike 50 or 55, sorry. I think it's plenty of space here. And, again, we only need like up to 10 days of theta to be out of the position for the full profit target. So it looks pretty good for me. 55 is quite far away. for the short put. You can go lower. It's up to you for your risk tolerance, but 55 will be the absolute closest I will get to the current price. So with that, let's see and exactly what we can get on Interactive Brokers. So the contract that I'm choosing is 51 days to expiration. This is the closest to 45. If you go ahead and sell the 55 put, so obviously we will sell 2 of them. Now this put is worth about 0.4. So when we try and buy our put spread, we want to aim for that same spread. So let's say, what if we maybe get the delta 45, delta 43 maybe. So let's see, maybe if we can go to delta 40 and strike 64.5, and then sell strike 63.5. So here the difference between the strikes will be paid exactly by one of the short put contracts, and then the other one will just be complete profit. So I'm not going to go over the diagram here. Let's go and see what it looks like on Optionstrat, just much easier to look at. So we sold the 55 puts, 2 of them, then we bought the 64.5 put, and then we sold the 63.5 put. So basically we have a pretty good profitability zone if the price goes up. If the price goes down, we can make potentially much more money. Now at the same time, you never really want the price to go all the way down here, right? Because this is what the price movement looks like, or what the payoff diagram looks like at expiration. But before expiration, this is what it actually looks like. So if the price drops down, it's not good for us at this point, right? This is why we want to roll only the short puts if we are down 100% of credit, which should be, what is it, around this price, give or take, depending on what's happening. And then we can keep the long put spread still open on the same expiration. It can make us quite a bit of money, and then the short puts will be pushed down even more. At the same time, the 112 works really, really good on crude oil and gold as well, because commodities, they crash upwards. So if a commodity goes down pretty strongly, volatility usually does not expand, it actually contracts, which is, again, good for us. This is why it makes much more sense to do the 112 on something like crude oil and gold as opposed to doing it on the ES. Now with $450 in credit, let's see what is the theta. Theta is about $29. So if we take profits at half of 450, at about 225. According to this data, probably we should be in a position for close to 8.5, 9 days to be able to get a 50% profit and be out of the position. Then we can reposition based on what the price is basically doing. So this is kind of the baseline of what I would do and how I would manage a position like this and when I would enter it and why specifically crude oil. Hopefully this was a pretty useful video for you. I'm trying to make as much useful content as possible based on my experience, and be very specific with how to deal with bad situations and when to trade and how to trade it, or crude oil in this video, for example. So again, thank you so much. If you have any questions, let me know in the comments. If you have any requests for a specific video to make, let me know as well, and I will catch you in the next one.